right. Good to see the room is still full. Lots of people taking notes. Good to see. So until now, we've been talking about the tech side of staking and restaking. Now we're going to make a bit of a transition over to the business side of staking and restaking. We've got quite an impressive panel. I'm not going to read all their names off the screen. I'll let them introduce themselves. But yeah, let's please give them a warm welcome to our panel.
All right. How are you guys? So today we have a very interesting panel, building the institutional grade restaking portfolio. And I am joined here by my co-panelists. Unfortunately, we're missing one guy. But we have Ezra from Fireblocks. We have Kelvin from Director of Bitget. And we have Gaia, CEO of Byzantine Finance. And me myself, I am Kristiansen. I'm working on the layer 1 Ethereum at Nethermind. But first things first, would you like to introduce yourself, Ezra?
Yeah, absolutely. So it's great to see so many familiar faces here today. I'm Ezra. I work at Fireblocks. I focus on our protocol strategy. So that includes everything on the blockchain side, the blockchains we work with and integrate, and it also includes our staking strategy. And Fireblocks is the largest institutional-grade wallet solution. Since our inception, we've seen $10 trillion worth of transaction volume, and that's done across our 2,000-plus institutional customers who've created hundreds and hundreds of millions of wallets.
Kelvin?
Hi everyone, this is Kelvin from Bitget. Heading the financial product departments, essentially covering savings product, our staking products, structured products, and the loan products as well. Before I joined crypto, I was with our institutional asset management space with BlackRock for around half a decade. So that's kind of shaped up our thought process in terms of how staking can make an impact for an institutional portfolio perspective. So really excited to be here, exchanging insight with you guys, and share the perspective for one of the fastest growing exchange out there on the staking topic. Yeah.
Glad to have you. Gaia?
Good morning, everyone. Super excited to be here, excited for this new location, and excited for the next location as well, actually. Looking forward to Argentina. But I'm Gaia, CEO and co-founder of Byzantine Finance. What Byzantine focuses on is restaking and essentially making it accessible for institutions. And institutions have very specific requirements on how to access very specific kind of financial products. So we make it very easy and compliant for them to access restaking. Cross chains, cross protocols, any ABS, any risk profile that they wish to expose.
All right, so I think we should start with some definitions, even though I think we already did it. But restaking, native staking, AVS, what is all this?
So I can go first, and I think that an easy way and understandable way of explaining what restaking is thinking a little bit as an internet bond, right? Where you essentially gain exposure to different underlyings. And in this case, the underlyings are different blockchains or different protocols. So gives access to a kind of like a low-risk yield, and this is why at Byzantine we believe that it's such an institutional great opportunity, because you don't trust it to be a very degen kind of product, because you're never going to yield probably a 50% APY. But it's going to be this complementary investment to staking, and staking is already very appealing to institutions. So essentially, what is bringing on top of staking is that instead of validating transactions just on Ethereum, for example, and earning rewards there, a validator can expand the kind of validation work that they're doing to other networks, other blockchain that require security, and therefore bootstrap the security of that same protocol, and at the same time earn additional yield.
Yeah, I think I'll add too. It's really an elegant solution actually for the problem of decentralized validation. Applications generally need to be validated, and I think we see this in the crypto space generally, that there are centralized solutions for things. We want to create decentralized alternatives. And I think there's been a lot of talk today about like what restaking is and how it works, and the cold start problem. And I think one thing not focused on as much that's interesting is just there's not unlimited capital out there. And I think you see this across all of the TGEs that have happened in the past year. Especially for certain protocols they'll launch, they'll attract a lot of volume, people will farm them, and then they'll move their assets to a different protocol, and it depresses the price and the market cap of these protocols, and then you have additional risk of people being able to get a certain amount of stake and then impact the protocol. So I think, and on the other side, on the investor side, you have investors sitting on, we just heard from Babylon, lots of Bitcoin, ETH, other assets, and if they can leverage what they have to secure these other applications, it's just a really interesting solution. And I think we're just scratching the surface of what these applications will be. And then we'll get into it too, but it also, the opportunities then on the investor side are super interesting, where there's a really good solution for apps and for all these decentralized applications, but then I think what we often see is there's a lot of ways that investors can make money in this space too.
Yeah, and I think just to that, I think it's really, from a centralized exchange perspective, really important to kind of simplify some DeFi concepts to our institutional users, traders. So I think essentially it's basically like in shorts, we always encounter the questions about our opportunities and risks. So I think I think restaking is kind of enhancing the capital efficiencies with additional rewards, but also I think we need to be very mindful about some of the risks that would be involved. Yeah.
We talk about the institutional grade portfolio. How exactly does restaking fit into that?
I mean, I can give at least what I see from the Fireblocks perspective. Like, I think conceptually it's really interesting, especially for, like, I'll take a step back actually. I think the two biggest opportunities that we typically see for staking are the B2C side, like the retail-facing exchanges and fintechs, and then the asset managers. And I mean, what we see is if there's an opportunity to juice your yield, you're probably going to explore that. I do think it's relatively early, and we have customers all over the risk curve, some that are jumping into these opportunities, some that are saying we're going to wait and see how it plays out. But ultimately, like, if there is an opportunity to generate, especially if you think about the Bitcoin side, last I checked, I think it was like sub 0.5%, 0.2% of total Bitcoin staked. It's a ridiculously small number. And if you can think about even earning 3% on top of the Bitcoin you have, that's potentially serious revenue. So it's attractive to the B2Cs because they can offer really competitive products to their end users, because there's a lot of competition in that market too for market share of end users. And then for the asset managers too, I mean, that's also, many of them are now sitting on Bitcoin, but they also have ETH, and if they're able to restake it as opposed to sell it and take the capital gains hit, if they're already long on ETH, then it's kind of a no-brainer for them if they can get comfortable on the risk side.
But I'm wondering, like, institutions are all these TradFi dinosaurs, right? So when you talk restaking and all these new buzzwords with them, there must be some barriers you must overcome in your work. How do you deal with that?
Yeah, I think that there are multiple barriers to accessing restaking. And of course, it depends on the kind of client that you're discussing with, right? So if it's like native, they already do staking and maybe they'll do looping, then the barriers are definitely limited there. But one of the key things that I see, and that we're seeing at Byzantine with our institutional clients, is that right now, one of the biggest solutions that there are to access restaking are LRTs. The problem with LRTs, and that's definitely a spicy take, is that they're non-regulated hedge funds. So what happens essentially is that you don't have access to moderating your risk, right? You don't know exactly where the capital will be deployed, and you can't really decide where the capital will be deployed. So for most of the institutions, that is a problem, because if you are deploying a few 100,000 euros, that's a thing. But if you're moving a large amount of capital, as like a few millions, 1 billion maybe, then you want to know the kind of risk that you're getting into, and you want to potentially decide how to deploy your capital. So I'd say that profiling the risk and having composability in the solution that you're using to deploy that.
What about you, Kelvin?
I think I would take a bit of different perspective, as in from a centralized exchange perspective. We are essentially offering products for our users, so be it retail or institutional. I think the way how we're presenting restaking this concept product to our users is very important as well. And we have to think about whether restaking should be kind of a default option or an option for user to opt in, where there will be additional risk involved. And by doing that, we need to articulate the kind of the risk involved. We need to have different tools or showing to our users that, oh, how is this restaking would affect the yield, what's the risk involved. And by that, I think for exchange perspective, we are actively working with different staking operators, restaking operators, in order to kind of connecting the gaps between like restaking, other risks involved, whether with insurance, with our institutional traders and users.
Gaia just mentioned compliance, and I'm just curious because as a centralized exchange, you must deal with a lot of that.
So our point of view to that is that when you deploy the assets, again, you want composability, you want to make sure that you know where you're deploying. And the way we're handling it is in the same way that Morpho for lending is handling it, right? So essentially giving this tool that allows you to deploy the capital as you want. So access to any kind of staking operator, because it's a fact that funds, hedge funds, but custodians, exchanges use multiple staking providers at the same time. It is complicated because you need to integrate with multiple ones, and then you need the tracking system that tracks the rewards from all of them. So what we do at Byzantine is that we aggregate the access to all the data from everyone, and we make it extremely composable cross chains, cross protocols, and EVS.
I think one thing I'll add too on this, it's really interesting in this space because we have all these innovative founders building complex products that solve these incredible problems, and one of the things that they then need to hire people to think about is how do we actually get people to stake these things, and that's like a financial problem. That's like a completely different area than they focus, and credit to I think everyone that just spoke on the previous panel. I'll give an example. So in the US, and I think this is something that people overlook often. In the US, if you're a fund that has over $100 million, you need to register as what's called an RIA. And if you are an RIA, a registered investment advisor, you have to use a qualified custodian. So that's like a third party that has a license. The three primary ones in the US are Anchorage, BitGo, and Coinbase. And if you want to attract any fund that has basically any fund over $100 million in the US, you need to get your protocol supported by a custodian. So, and then I think something we might get into later is there's all these structured products as well, being able to meet institutions where they are. But yeah, it's just you need to be able to, as a protocol, think about all these other things. And then on top of that, we have LRTs, we have protocols like Mello, and really if you want to attract capital, you got to think about how do we build products, integrate to solutions that institutions use, because that's the most powerful way, I think, to get distribution and to acquire TVL.
You want to add something?
Yeah, I think just to add on that, from kind of our experience dealing with our regulators' perspective, I think in terms of crypto financial products in general, you need to consider there are other alternatives. Like say, we work on like structured products. So I think staking is kind of already a innovative concept if you're introducing it to them, coming on all like financial background, traditional perspective. So I think it definitely kind of need to take a little bit of step at a time. Definitely relying on everyone's kind of being vocal about what restaking is, what does the risk involve, in order to actually kind of pushing the regulatory landscape to be more welcoming on restaking concepts, which will help institutional adoption. So I think there's a lot of things about educating the regulators, institutionals, and I think centralized exchange here is also taking an important role here to disseminate the information to our users.
So I actually want to ask you guys, because me coming from the layer one, we sort of embody and breathe these crypto values, decentralization, permissionlessness. What do you think about all this institutionalization of crypto, and how do you reconcile this shift or opposites between the institutional side, which is centralized and trusted, and the crypto side, which is decentralized and trustless? Ezra?
This is, I think, one of my favorite questions, just because I think back to like 2017, 2018, when if Larry Fink said the word Bitcoin, it would go up by 20%, and everyone was like super bullish on this idea of the institutions are coming, and now they're here, and people are starting to question like, oh, but they're not doing it in the right way. And I think, first of all, if we want to get significant adoption, if we want the price of these assets to go up, which then adds more value to the space generally, we need to sort of take a step back and understand these institutions have a very particular way that they do things because of their regulators, because of their internal operations and compliance teams. And if we want them involved, they're gonna have to do it in ways that sort of, in many cases, go against the ethos of crypto. But what I will say that's encouraging is we have had conversations with regulators and with other regulated institutions that say we want to self-custody. Like when the regulators allow us, or maybe in the next couple of years as our team gets more comfortable, we're hopefully going to be able to hold assets spot or be able to connect directly to smart contracts or DeFi protocols. But what I will say for now, though, I think we just saw in Q1, Abu Dhabi's sovereign wealth fund just bought $500 million worth of a Bitcoin ETF. And from my perspective, that's a huge win. It's an ETF, it's not spot, but that's great for the space. And if you think about that size of investment, if that goes into restaking or any of these staking protocols, it would make them significantly more successful. And if the issuer of these assets also figures out a way to manage it in a productive way, I think it'll end up working out well for the protocols, and I think it's a productive step. Hopefully we see them move in the direction that we want towards self-custody and DeFi over time.
And Gaia, you, Byzantine Finance, you brand yourself as a decentralized offering. How do you see it?
Yeah, so that's a great question, and I'd love to take a step back to answer. And it's gonna feel very Web2, but the way we believe about approaching institutions and the way we think that building a product for institution makes the most sense is by really spending a lot of time understanding what they want. So what we did was literally just 5-6 months of just discovery. What is it they want? What are the features? How do we integrate with someone that is centralized? But we want to fit in what we believe in decentralization, and we want to work with institutions because we also believe that the way for this industry to eventually grow is by bringing in traditional finance kind of investors and working also with the institutions that in crypto are regulated. And so there are multiple ways actually as a decentralized protocol that you can work with institutions. And the way we offer our services is as a toolbox, right? It's like a Lego. We give you the box of Lego, and then you can build what you want. You can build what's drawn on the box, but also you can build other things, right? So this is the way we approach it. We don't need to be regulated. We're just like offering the pipes, we're offering the bricks for those institutions to actually offer the final product. But we make it in a very easy way, because one of the other problems that I see a lot in our industry is that we tend to overcomplicate a lot of things. And sometimes having a lot of features and a lot of composability is great, but maybe not all the time, because it can be, very overwhelming and very complicated at one point to use. So what we did is really including the kind of features that were needed based on what we learned and the feedback loop that we've got from our actual clients.
But the type of institution clients you deal with, do they see the value in all this crypto ethos?
Decentralization?
Decentralization, permissionlessness, trustlessness.
I think that the thing that they appreciate the most is really the composability, right? And what Byzantine allows you to have is also a more capital efficient restaking offering, and one that aggregates the access to all the restaking offerings in the whole industry. So they definitely appreciate the composability and the full access to everything. And that decentralization of the protocol itself is not necessarily like a con or a pro. It's something that is there, not the main feature.
All right, very interesting. Kelvin, you're a director of a centralized exchange. So all this restaking, new packaged products for institutions and so on. We had the collapse of Lunar, we had Celsius. Why should institutions trust that this isn't just a new fancy pyramid scheme?
That's right. I think for some of those historical events, I think they are actually a very good learning from history. I think some of protocols or CeFi institutions are imploded due to opacity, kind of a lack of transparency and over-leveraging. And by offering restaking products to our user, it's actually kind of flipping the coin of it, as in we are being kind of a platform to let user to decide whether they are doing staking, restaking, or even they're not doing anything with the assets. So I think that's one of the key points, like of key improvement, where restaking is actually not like degen yield farming kind of things. It's kind of like well thought through actions carry out from the stakers itself through through standard mechanisms. And I think from a centralized exchange perspective, we can how we differentiate from like directly participating in the ecosystem is that exchange actually got the proof of reserve guarantee, we got our customer support, we have like guarantee uptime. Whenever you have questions, we're there to answer your questions, or kind of bridging the gaps between what's going on. And at the same time, as a platform, we do have the leverages to obtain more timely intel information, or even participating into some of the governance protocols, etc. So I think it's definitely kind of helping our institutional users to get more comfortable with our restaking in general. And I think lastly to add, I think one point is really important about capital efficiency as well, especially some of the large asset owners. They're not just thinking about generating return through restaking. They're doing all sort of like trading strategies, or could be doing loans, trying to maximizing the capital efficiency of the idle assets. So I think centralized exchange is a place that we can provide the liquidity, the services, or even if some clients would like to prefer self-custody, we'll work with some third-party custodians to provide a holistic solution to all sort of institutional clients to fulfill their needs.
Fireblocks you offer a lot of institutional products in different packaging. Do you think that having all these institutional elements in crypto somehow corrupts, or how do you deal with, so like an institution, you want to have someone who is responsible. At the end of the day, if you lose my money, I want to sue you. So how do you deal with that in a decentralized world where there's no central, or there's no guy you can point to, hey, you lost my money, give it back?
Yeah, I mean, so Fireblocks is a non-custodial self-custody product, so I think this is something that's very relevant to our customer base. When I think of any of these products generally, like any sort of restaking or DeFi product, it's interesting in the sense that there has never really been a product that has this type of risk profile, where you're going to institutions that typically would just think about the financial risk associated, like the counterparties and potential default risks, and now you're going to institutions and saying, all right, we'll audit the smart contracts, think about your key management in your wallet, think about how to confirm that the dApp you're connecting to wasn't spoofed. Like, it's a ridiculous list of things that they need to start thinking about. But there are enough solutions, and I can say firsthand because of what Fireblocks provides, that there's no excuse at this point to lose your own internal money, LP's money, and customer money because you use an inferior product. Like, this is also super relevant. We just saw this with a large derivatives exchange using Gnosis, right, where there are products, and it's not just Fireblocks, there are other ones as well that use trusted execution environments and have policy engines that not only present you with a translated message to show you what the transaction is going to be, but then the smart contract address is whitelisted and there's limits to what can be sent. And if what you're intending to send is different from what you read, it'll block the transaction. So I think that's like the first step. There are many institutions that aren't comfortable yet getting involved at all because of the other side of it, getting comfortable with the smart contracts, getting comfortable with the other crypto native risks. But for those that are, the wallet and the key management is a no-brainer. Don't cheap out on key management because we've seen way too many people lose their money and it's a very solvable problem.
Yeah, if I can add something on this, I couldn't agree more. I feel that a lot of the problems that can be felt, like they come with the decentralization, are actually quite solvable. For example, access to funds. Okay, we solve it by issuing vault shares. So at any point, you can just like withdraw your part of the money, even if like Byzantine falls down and like falls apart. You do still have access to your capital. And smart contract risk is there for everyone. It's there for, it's not exactly smart contracts, but it's like more an organization risk that is there for centralized organizations as well. And I think it's very comparable. Difference being that smart contracts you can audit, and if you build it in like a smart way, so for example, like the core of the protocol gets audited multiple times and it's like unchangeable, then that's a very easy way around this kind of problems.
So we don't have that much time left, but when is the big money coming? When do we see the next big wave of institutional money flowing into crypto?
That's a great question. I can take it. I can start. We, as you know, at this point, we focus on institutions, and we're seeing that a lot of like are coming to restaking because they see the opportunity, and they're mostly scared of missing out a market that is being growing massively. And so, one custodian integrate restaking, and all of a sudden everyone turned to integrate restaking. And overall in the market, we see a lot of segments that are very competitive against each other. It's the case for wallets, it's the case for exchanges, staking providers, and I think that they all kind of started already. They're getting into restaking. Staking, I'd say, is already something that is widely adopted. And on the traditional finance side of things, we've seen a lot of family offices that are already staking or that owns crypto, and that for them makes a lot of sense to restake their assets or part of it. And I believe that large asset managers are coming next those, right? So staked ETF is on the way, and why not restake one later down the line?
Kelvin?
I think just to quickly add, I think you're talking about big money from a magnitude perspective. It needs to be, I think, Bitcoin related, or it could be something that's a cross-chain kind of aggregating all the tokens in terms of restaking. Because if you're just betting on one single protocols, I think at least from an institutional perspective, you're talking about big money. There's still a long way to go. So I think my major bet or my kind of our thoughts will be more on Bitcoin, or if you think about a long tail of assets, how do you aggregate all of these?
All right, unfortunately we are out of time, but I would like to thank my panelists here and the Staking Summit for having us. Thank you guys.
Thank you so much.